Maria, Diego, and Sofia and Will. And we have other group of close friends who are Dija, Grace, and Annie. And Dija, Grace, and Annie are realtors. I'm going to throw a couple of things here for the homeowners because as a homeowner, hi Diego, you're here. Now I see you. So when we're talking about, for example, refinancing, that's one of the things. Other things that people are thinking about is getting some cash out to invest, which also applies for people in the real estate industry because they do have clients that purchased a property a year, 2 year, 3 years ago. And for example, some people are, well, if I already have a good rate, a good interest rate, I don't really need to refi because also of the cost of refinancing. There is a cost involved in it. So why would they want to even, what is there right now for them that is beneficial for homeowners on that side?
So right now, there's really two main reasons that you're going to want to refinance. Number one is exactly what we're talking about on the the article there, which is the interest rates right now are absolutely phenomenal. The interest rates haven't been better in a long, long time. Okay, they're at the lowest level they ever been. So if you have an interest rate over 4%, then that's the opportunity. That's one opportunity to look at refinancing, is to lower your rate. If you're somebody who's already sitting with an interest rate, less than 4%, and you're wondering, why would I want to refinance? Well, the reason is because you've got a lot of equity sitting in your home. And equity that's in your home is earning you 0% rate of return, okay? You can't do anything when the equity is sitting in your house. Now, understand that your home value is going to go up or down regardless of how much you owe on the mortgage, okay? The mortgage balance has no effect on whether your home value goes up or down. That has to do with the market. So the money that's sitting in equity in your home, until you either sell it or get a mortgage on it, it is earning you nothing, okay? So the question you want to ask is, how much money is it costing me to do nothing, to let that money just sit there? What could I do with the money that's sitting in the equity in my home that could earn me greater than 0% rate of return? Because when it's sitting in the home, it is earning you zero. That is guaranteed. So if you have an opportunity to buy a property and make a 8 or 10% return, that's option one. If you have an opportunity to pay off debt, maybe you're paying 15 and 20% interest on your credit card debt, like a lot of my clients, why would, it makes total sense to take money that's earning you zero and pay off credit card debt that you're paying 15 or 20% on. Okay. So going back to what Sophia said about closing costs, like, yes, we know there are closing costs when you buy, sell, or finance real estate, especially in the state of Florida. Okay. The state of Florida has some, transfer taxes and tax stamps and things that not all other states have. So there is a little bit more of an investment, but that's what you want to look at it as, is don't look at it as closing costs. Look at it as an investment, okay? When you start seeing it as an investment, then the question becomes, what's my return on the investment, okay? So if it was going to cost you $7,000 to refinance your home, but you could earn $15,000 by doing that, then you could see that that's a very good rate of return. And it's easy to calculate. So if it's going to cost you $7,000 to refinance, and that's just an example number, your number might be higher, it might be lower. But if you can get a good return on that investment, okay, then it's going to make sense. Now, Diego is asking about refinancing multiple times and you can only refinance once. Absolutely not. I have some of my clients that I have refinanced 5 times over the last several years. Okay. Every single time there's a different motive. One time, maybe it's to lower their rate. Another time we're pulling out money to pay off credit card debt. Another time we're pulling money to buy another property. Another time we're taking them to an even lower rate. Another time, maybe we're going to a 15-year mortgage. So there's all these different reasons to refinance your home. Yes, when the rates are low, it makes more sense than ever. But a year or two ago, I was having people refinance and their rate was going up. And it still made sense, even if their rate was going from 4.5 to 5, if we were paying off a bunch of debt and they were going to save $50,000, then it made all the sense in the world to pay the closing costs and have their rate go up a little bit. So I want you to disconnect yourself that these are closing costs and start looking at it as, I'm going to invest money to get a return. Does that make sense?
Hey, Robert, I got a quick question.
Yeah.
All right, so let's say your current equity is of lesser value than what the closing cost would be to refinance. What incentive is there truly to refinance?
So what you're asking is like if you don't have enough equity to pull money out and your simple benefit would be to lower your interest rate or lower your payment, what would the benefit be if it's going to cost you? Is that correct?
Yeah, more or less, just because, I mean, if I have to pay $5,000 or $6,000 out of pocket and I'm not getting any money back because I'm still on a 24-month, I've only been in my house for 24 months, so to speak, then, if I'm not looking at losing my, a mortgage insurance or
Mhm.
pulling extra cash out, then I'm not sure if I see like the huge benefit, but maybe there's something long term. I don't know. That's what I'm
Yeah.
asking.
So first of all, I'm glad you mentioned that because at least the way I structure my refinances, there's almost no out of pocket costs. So when I talk about closing costs, those are rolled in to the new mortgage payment. Those are included in the new mortgage payment. The only out of pocket cost that my clients typically would have to refinance, if required, would just be for an appraisal of the home. And a home appraisal, you're looking at less than $500 total out of pocket expense. Okay. Now, that doesn't change the fact that it is going to cost money, but it's not out of pocket money. It's not you writing a check from your bank account for $5,000 or whatnot. It's money that's simply being bundled in or rolled in to your new mortgage payment. Okay. So it's being included in the whole thing. So to answer your question, if it was going to cost you, say, $5,000 to refinance, but you were going to save $300 a month, okay? So what you do is you take $5,000 divided by 300, and you'd see it will take you about 17 months to recoup the cost of refinancing. Now, the rule of thumb in really forever that I've been doing this has been if you can recoup the cost from refinancing in less than 36 months or 3 years, then that's typically going to be the cutoff point where it would make sense. Now, it also has to do with how long you're going to stay in the house. If you know that you're going to sell your house in the next 12 to 18 months, then it doesn't matter what the rate is. It probably is not going to make sense to refinance. You're just not going to be in the house long enough to recoup the cost. But if you know that you're going to be in the house for 3, 5, 7, 10 plus years, and you can save hundreds of dollars a month on your mortgage payment, then as you can see, it's simply a matter of looking at like cost versus benefit. How long is it going to take to recoup the cost? Because it's not coming out of your pocket. It's being built in. It's being paid out of the equity that you have and out of the new mortgage principal. Does that make sense?
Yeah. And when going back to Diego's question, if you can, so people can refinance multiple times. At what point could it hurt people to be refinancing too many times? Like, what is the window period, and also from the time that they purchase, what will be a time frame that will not hurt the homeowners to refinance?
Okay, so my experience has been, especially in the last few years, that once you buy your house, depending on how much you paid for it, the value and whatnot, I have had multiple clients just in the last 90 days that bought their house less than a year ago and they're refinancing now and they're saving a ton of money, both by pulling out equity to pay debt, doing improvements on their property or doing, renovations or additions, and of course lowering their rate. I mean, that's the no-brainer is, you bought the house a year ago or 8 months ago at a 4.5% rate. Now you can refinance at a 3.5% rate and your payment goes down by $300 or $400 a month. Okay. And most of those clients, like we were just talking about, they're breaking even on the refinance costs within like a 12 to 24 month time span. Okay. So it's well worth it because they just bought the house. They're not moving anytime soon. They're keeping this house for a long time. So they're going to really be able to benefit. So to answer your question, I typically do an initial fact find with my clients after they've been in the house about 6 to 8 months. That's usually the first time when we'll look at it is between 6 and 8 months. I've had clients that bought a house 6 to 8 months ago and the house is worth $50,000 more after 6 months just because they got a really good deal on the house. Their realtor did a great job negotiating. They got a really excellent deal in a great area, and their home value has gone up significantly. I had a client whose home value went up $200,000 within 1 year of them buying the house. Now, they did a little bit of renovation, nothing major, but they did, some painting and some cabinets, and they spent about $15,000 on renovations, and their home value went up $200,000 from when they bought the house versus when we had the house appraised, okay, less than a year later. So that is not the norm, okay? That's not how everybody is.
This is very much from like an investment perspective, which applies to both sides. If you are a homeowner and you go in with that mentality, for example, let's say we buy a house 2 years later, we built 50,000 in equity, we pull it out, we invested in a new property, and that's a risk. But it will be like more of a mentality like that than when they are doing it as many times.
Yeah, so with that client that I was telling you about, he had put the $15,000 in renovations that he did. When he bought this house, he knew it needed a little bit of work, okay? But he got a really, really good deal on it. And he put the $15,000 in, but the thing was, he was using credit cards. So he had a credit card with $5,000 on it. He had another credit card with $6,000 on it. He had another credit card with $4,000 on it. And all these credit cards had 12%, 18%, 22% interest rates, okay? So what we did was, his initial motive when he came to me was just to drop the PMI off his mortgage, the mortgage insurance, and lower his rate. When he bought his house, his rate was like 4.375. So we were gonna lower his rate to 3.6 and drop the mortgage insurance. But then what happened was, nobody expected it, but the home appraisal came in $200,000 over what he paid. So then, by the house being worth so much more, we were able to actually pay off all the credit card debt that he had, all that high interest debt that he had taken out while he was doing the renovations on the home. We took that money out of the equity of his home. We paid all those debts off, okay? So they all went to zero, and we still lowered his interest rate, and we got rid of the PMI. Okay, and this is a client that literally closed with me in like the last 3 weeks. This isn't something from years ago. I mean, this is someone that bought a house in mid-2019 and refinanced in, early 2020 or early to mid-2020, and they put just a little bit of work into their house, and it just so happened that, again, they had a large amount of equity in there, more than we would have ever known. But the thing is, this client was willing to take the risk of paying for an appraisal and willing to move forward with a refinance, not knowing exactly what hand we were going to be dealt. And then when that appraisal came in, it came in substantially more, and it unlocked all these opportunities. If they had sat there and said, oh no, refinancing isn't going to make sense, I've only been in my house for less than a year, so it's not going to work, they would still be sitting right now with high interest credit card debt, with all this equity pent up in the home. They'd be paying mortgage insurance, and they'd be paying more interest than they need to on their mortgage. So I guess the moral is, you need to be aggressive with this. You need to take advantage, or at least try to take advantage of the opportunity. If it's not there, then fine, but you need to be looking at this stuff on an ongoing basis. So going back to your question is, how often should you be looking at refinancing? Like I said, once you're in the house, within 6 to 8 months. Once you've been in the house for a year or so, I do an annual review with every one of my clients, okay? So at least one time per year, you should be looking at refinancing. Even if you think, oh, it's not gonna make sense, you still want to at least look at it. You might be surprised at what type of numbers you can put together and what type of opportunities you can unlock, regardless of what you think as a homeowner. You're not in the market every day. You don't know what interest rates are exactly. You don't know maybe exactly what your credit standing is, or all these other factors. So you definitely want to look at it at least once a year, because at least the way I do business, there's no application fees, there's no obligation or commitment. So literally you have nothing to lose but a little bit of your time.
Two things, Robert, because Diego is asking what are the cons. So that's one. And the other that I didn't ask earlier, part of the reason why I really like what you do is, what is the difference working with you when it comes to, what's the difference? Because for homeowners, we don't really know what it means, a direct lender versus the bank that we used before, or the mortgage broker that we used before. So that's one, like, what is the advantage on a direct lending, what that really means, and what are the cons, like Diego is saying, on doing the refinances? And then I have
Okay,
one more question
so
after.
yeah, so let me answer that question in the opposite order. So let me first talk about the cons of refinancing, which are, depending on how you are structuring your refinance, the biggest con is that in many cases, you're going to reset the amortization table. So if you had a 30-year mortgage and you've paid 1 year into it, you have 29 years left. If you refinance again, you're going to go back to 30 years. Okay, that's the con. Now, with a lot of my clients, we accelerate their amortization. So instead of going back to 30 years, maybe you go to 20 years or you go to 15 years and you can get ahead. But in a lot of cases, that might require, depending on how long you've been in your home, it might require that your payment would go up. If you go from a 30-year mortgage to a 20-year mortgage, your payment is typically going to go up. Not all the time, but most of the time, okay? So the cons are that you potentially would reset your amortization. And of course, like we've been talking about in depth in this conference here, is the closing costs. Those are the two biggest cons that you've got. But again, you want to look at it as, am I going to get a return on my investment? If I go from 29 years back to 30 years, but I save $300 a month, well, then is that really a negative? Is that really a con? Or can I use that $300 a month that I'm saving to pay off debt maybe somewhere else, to invest in the stock market, to invest in my 401k, to put more money towards retirement? See, there's so many places that people can use money, but the mortgage is the single biggest expense that most people have. So if there's a way that we can lower your mortgage expense, now that frees up money that you can use for all these other opportunities outside of real estate. Like I said, paying off debt, retirement, investments, that sort of thing. And of course, yes, you could use it to buy other property and do other real estate things, but not everybody wants to be a real estate mogul. Not everybody wants to own multiple properties. So if you save $300 a month on your refinance and put that towards your 401k, think about how much money that would give you 10 or 20 years from now if you put that money into your retirement plan and had it growing exponentially. I have a lot of clients right now that's what they're doing, is they don't care about going back to 30 years on a mortgage or going back to 20 years on their mortgage, because it's freeing up money that now they can have a good retirement. Now they can fund these other needs. Now they can pay for their child's college education, and they don't have to worry about it. The days of just getting a 30-year mortgage and paying it off, that's not the current environment that we're in, okay? That's the way our parents and grandparents did it back in the 20s and 30s. That was the norm. This is 2020, okay? Real estate finance, mortgages have come a long way. We can't use the same wisdom that our parents and grandparents use. The average homeowner right now gets a new mortgage every 3.5 years. That's the statistic right now today. So if you know that statistically you're going to get a new mortgage, buy, sell, or refinance in 3.5 years, then that should explain why you really don't want to get too wrapped up in, oh, I'm going from 28 years back to 30 years, or I'm going from 16 years left on my house back to 20 years, okay? But if that is a concern for you to pay your house off quickly, then you need to let your mortgage advisor know that. So when they're preparing your refinance options and proposals, they can make sure to keep the same amount of time or less than what you have now on your mortgage. There are ways to do that. It just needs to be communicated up front. So that's the first answer there. Now, the second thing Sophia was asking was about, direct lender versus mortgage broker. And, I know me, her, and David had a long talk about this a few weeks ago because, with COVID-19 coming about, what had happened was about 60 days ago, a lot of mortgage companies, a lot of mortgage brokers went out of business or stopped funding loans. Okay, all of a sudden one day, all these loan programs were gone. Nobody was buying these specific types of mortgages anymore. And, that's one of the risks of dealing with somebody that is not a direct lender, is that they're not lending their own money. So they're at the mercy of the investors. They're at the mercy of the people that they're brokering the loan through, which means that if you had a mortgage in process in late February with a mortgage broker on a bank statement loan, for example, you got a call the first few weeks in March or mid-March that said, hey, we can't do your mortgage anymore. And it had nothing to do with them. It had to do with the people that were buying the loans from them. They no longer, because of the economy, were willing to take the risk of buying those type of mortgages. Now, like Sophia said, I've been doing this now over 17 years, and the company that I'm with is a direct lender. Okay, and I've been recruited and constantly have things going on with people trying to show me, hey, you should be a mortgage broker. Here's why. And I was a mortgage broker. My first several years in this industry, I was a mortgage broker. So I've seen both ways. But what happened recently is the people that were mortgage brokers or did not have a direct lending channel like myself, they were in a position where they could not fund loans. They had clients that were ready to close on mortgages, and maybe you as a real estate professional or as a homeowner, maybe you heard about this because it was something that's happened quite a bit during the month of March, where all of a sudden people got told, we can't close your loan. Why? Because that loan program is no longer available. There were people that went to a closing, okay, and got told, we never got the wire transfer for your mortgage. Why did that happen? Because they were selling the mortgage to a third party, and that person or that investor simply couldn't sell the loan anymore. So all those loan programs went completely, out the window. Now, I can tell you, I didn't have one client that had that happen to them. Every single one of my clients closed on time and closed with funding for their loan.
And that was it. So working with a direct lender, which means then you have your own cash flow to give to the customer, to the client. So this gives you direct communication with Fannie Mae. So you're basically cutting the investors, which is in essence the middleman. And how does this relate to lower cost and also better interest rate, as well as shortening of the time of the mortgage and less complications for the mortgage time or refinancing time?
Sure. So, just like any industry, the more middlemen you put, everybody takes their cut. Everybody takes their fee. Okay. So when you've got a loan that's going through an investor, a mortgage broker, a processor, an underwriter, all these different people that are involved in the process, everybody's taking a little bit. And mortgage brokers, for a long time, they had very good rates. But what this pandemic had done is a lot of mortgage brokers were in a position where their rates went up significantly, literally overnight, because the risk was higher. And of course, everybody had to still make their money. So with so much uncertainty in the market, a lot of mortgage brokers, were offering interest rates that were 1/4 to 1/2 point higher than a direct lender. So with that being said, my company, we're a direct lender with Fannie Mae, Freddie Mac, and FHA, which are the 3 biggest organizations that guarantee mortgages right now. So that just means that there is no middleman. We're a direct lender. So we are originating the loan to a consumer, and that loan is being sold directly to Fannie Mae, Freddie Mac, or FHA. There's no middleman or third party. The money comes off our credit line and then gets sold directly to them. So, that just means a better rate. Bottom line is you're going to get much better interest rates because we are lending direct with no third party. There's no extra fee to be taken by going through a middleman. Okay. And then from a certainty standpoint, we're selling loans directly to these government-sponsored entities. This is not a random guy in an office in Kentucky, or this is not a random hedge fund in New York City. This is the federal government. This is, Fannie Mae, Freddie Mac, and FHA, which are all government-sponsored entities. They are buying more. They are the biggest buyers of mortgages. There's no risk of them saying, oh, we're not buying those mortgages anymore. If you've been on this presentation the entire time, you know that I started off talking about how the Federal Reserve is buying more mortgages now than ever before, okay? So there's less risk right now than there was a year ago because they're putting as much money as possible, billions of dollars every day, into the mortgage market to prop this up, to support it, which means lower rates. Now, taking it a step further, as a direct lender, all of our underwriting, all of our staff is in-house, okay? They all work for my company directly. And I know there are a lot of other direct lenders out there. I can only speak from my experience, with my company, Benchmark Mortgage. So our underwriters, they underwrite only for us, and they're in-house. They're not underwriting for 50 other banks, and you're just a number. That is not how it works.
Sorry, what happens is that as a homeowner, as a normal customer, we don't even, that's like speaking a whole different language. We don't even, until I spoke with you, I really grasped the understanding of what that means. And basically is, I'm the homeowner, I'm purchasing a property or I'm refinancing. I go to my mortgage broker. Mortgage broker does the paper. the initial paperwork, which then gets sent to underwriters and other people, which then all of this gets purchased by an investor, and the investor who knows who they sell it to, and then it gets sold finally to the government, back to the federal funds.
Right.
So with you, same scenario. Instead of going through the investor and all of these people, goes directly to you, to Fannie Mae, which in that process decreases the time, decreases the rate that they can get, the efficiency, because it's less hands in the paperwork, so that the moment of closing or when they're doing a refinancing, there's a lot less complications that an average a mortgage sometimes will have, or David has
There's
been in
a lot
closings
less
that,
complications, a lot.
yeah.
So in the industry, we call it conditions.
Right,
Okay,
got it.
so when a mortgage broker goes and they send your loan to processing, the processing comes back and says, oh, we need these 3 papers. And then they come to you and ask you for those 3 papers. You give those 3 papers, then it goes to the next level. Then the next level looks at it and says, oh, we're missing these 5 papers. And then they go back to you and you have to give those 5 papers. There's this constant back and forth. Okay.
I love it for the homeowners, for my friends, and also for my friends who are realtors. I love that part of it, that it decreases the time and it decreases the rate and it decreases the complications.
Well, that's the biggest thing, is every time, it's like the game telephone. Every single time a different person looks at the loan, they're asking like for more information, and it's going to the back of the line. So I can just tell you, like, I have a refinance that got cleared to close today, and we started working on it 1 week ago. Okay, so on their application was on May 11th, and we got the clear to close on May 18th. Okay,
wow,
that's 1 week start to finish. If you have friends that have been trying to refinance, or neighbors or anyone, Wells Fargo, Chase, Bank of America, these banks right now are taking anywhere from 2 to 4 months to do a refinance, okay? And they are a direct lender, those banks, but they have such a backlog of applications, they have such inefficient processes and so many people trying to refinance at once that they're not even able to get to all those people. Now me, I only work with about 15 to 20 clients a month. I have to turn people away so that I can keep the service levels the way that they are, which are very, very quick. So I try to get all refinances done within 2 to 3 weeks, which right now, that's very, very quick. That's months quicker than anybody else. Okay, so that's the bottom line of why doing this with a direct lender like myself that has the quick turn times, it gives you certainty. You know the rate that they quote you, you're going to be able to lock in. I've had people tell me, Bank of America tells them the rate is 3.5, and then 2 months later when they're ready to close, they get told, oh, I'm sorry, the rate went up, it's now 3.9. And that's after months and months of waiting. Any real estate attorney or title company has many stories like that. I'm sure they can tell you, where all of a sudden at the last minute, after a month or 2 or 3 months, and you haven't even talked to another lender, and then you get told, hey, we can't do this at the rate we told you, or they don't even tell you. You just get the final paperwork and it's got a higher rate, and you've been working on it for 3 months or 2 months. Do you really step back and walk away, or do you just close? These are the types of uncertainty that you have when you're dealing with these big banks, these big mortgage brokerages and whatnot.
Robert, my final scenario, because I know everybody's falling asleep, on a normal house, and I know DJ also has a question that she's waiting for. On a normal house, let's say $350,000 house, purchased 3 years ago, rate was 3.5. What on that example, in average, because I know there are things come in place like credit score and all of that, but in average, if they have a 3.5, they bought it 2 years ago, what would be realistically something that can decrease in term of the year of the term of the loan, and also on the rate from the 3.5?
Well, the 3.5 is a good rate. Okay, so if that's their only motive, yeah, they might be able to get it lowered to 3.25 or 3.125 on a 30-year loan right now. That, depending on how much they actually owe, that might save them, $100, $200 a month. The big benefit that I would say is, if you bought your house a few years ago, do you have private mortgage insurance? Did you put less than 20% down? Because I find a lot of people have a low rate, but they're also paying PMI. So when you look at 3.5% and you're paying a 0.5% in PMI per year, your real interest rate is actually 4%. So if we could lower your rate to 3.25 and get rid of your PMI, you would likely be able to save several $100s a month. If your only motive is to lower your interest rate, then, you know, we'd have to look at it if going to a 15-year loan or a 20-year loan would make sense, because going from 3.5 to 3.375 with no PMI, that probably, you know, wouldn't make sense for you as far as that scenario. But it might make sense to go to 2.875 on a 15-year loan. Yeah, your payment goes up, but you get to shave a significant amount off the time of your loan and off the interest.
Is that so it is possible from like a 3.5 to a 2.8?
Yeah, if they're willing to go to a 15-year mortgage.
So
That's
Maria's asking, how about if currently is 5.25?
Absolutely. Like I said earlier in this call, if you have a mortgage interest rate higher than 4.0, okay, if you have a rate of higher than 4%, then you need to look to refinance as quickly as possible. That's all I can say, is the rates are, you know, much better to where it would make sense. If you have a rate in the 3s, then I would still recommend it, but you know, it's negligible how much the benefit is going to be. Now, going to Sophia's question here about, you know, the rates of going from a 15 versus a 30. So right now, a 15-year rate is going to be about 3/4 of a point better than a 30-year rate. So like if a 30-year rate is at 3.5, you know, 15-year rate is like around 2.875, 2.75. Okay, so that's the reason why people want to do a 15-year loan versus a 30-year, is a 15-year rate is going to be a lot better. And even if all else is equal, obviously a 15-year mortgage is going to pay off a lot quicker. So it's going to save you a lot of money no matter what. And the other question was, would there still be a wait? No, there is no wait. Like I said, if you've lived in your home for at least 6 months, it's not too early to look at refinancing, okay? The worst case scenario is you look at to refinance, it doesn't make sense, or the numbers don't work, or we do have to step back because of your equity or because of these other factors, but then we'll put a timeline together. We'll figure out like how long you need to wait, not because you have to, but because of the numbers. Everyone's situation is different, and somebody that bought their house a year ago is in a different situation than somebody that bought their house 10 years ago. So, but I want to put the myth to rest that there is no wait. Don't think about to wait. Don't think about I can only refinance once. Absolutely not. You can look at this as often as you want. And I would say if you haven't looked at refinancing in the last 3 to 4 months, you absolutely need to look at it now. The worst case scenario is you get told, hey, you're in a good spot, stay where you're at. But the best case scenario is you can save hundreds or thousands of dollars per month or per year on your mortgage. You know, and it's going to be a huge, huge benefit.
But
so
Maria works 24/7, and she has 2 babies, and she's such a superwoman for even making it here. She doesn't answer all of my calls for half of the year, but she's I love you, Maria. So yes, that's her question. I forgot.
Yeah, so the average closing cost, I mean, it's really hard to say because it does go by how much you own, or excuse me, how much you owe on your mortgage and whatnot, how much the property is. But I tell my clients, if you just want to figure out average calculation, in the state of Florida, it's going to cost you around 4% of the total loan of what you owe to refinance your home, okay? 4% of the total balance on your mortgage. So if you owe $100,000 on your house, it's going to cost probably around $3,000 to $4,000 to refinance. Now, there are ways that we can get the cost lowered. There are different ways we can manipulate that. But with that being said, a good rule of thumb is around 4%, or say between 3 and 4% if you want to try. But again, going back to what we talked about earlier, if you can save a significant amount by doing that, then we need to just look at the return on investment. So if it's going to cost you 4%, but you can gain 20% in return, well, that's a 4 or 5 time return on investment. Okay, so you got to start looking at your home and the mortgage as an investment and not as a cost, because a cost is something that doesn't have a return. An investment is something that you expect to get money back from. When you start to look at your real estate as an asset, as a financial tool, then you can see why this just starts making a lot more sense.
And you were saying that the payments get added into the total of the loan. So it gets split into the payments that she makes throughout the year. Anyways, it's not like off-pocket costs, which is something I also wasn't clear on.
Absolutely. I mean, look, right now with the current scenario in this economy, the last thing you want to do is write a check for $5,000, $7,000, $9,000. Like, that makes no sense. the way, I know not all banks do it this way, but this is the way that I've structured it pretty much forever, is rolling all the closing costs into the mortgage so that the monthly payment, when I say it saves you $300 a month, that's net. That includes all the closing costs in that total payment.
Oh, that's a great point. That's a great point. That it already has the closing cost included in it. And you said earlier about only if they need an inspection. Under what circumstances would they need an inspection in house?
So if you
Appraisal.
bought, yeah, so if you bought your house in the last couple of years, or you refinanced in the last couple of years and you had an appraisal done, then it's very possible that you may not even need an appraisal, because Fannie Mae, Freddie Mac, and FHA, they actually they database all the appraisals. So the appraisal that you had done a few years ago, it very well may still be in the system that they have. So when we run your address and your credit through an automated underwriting system, they'll analyze your property and they'll tell us whether we need an appraisal or not. Right now, for me, about 50% of my clients do not even need an appraisal because they've had one done in the last couple of years. Now, if you bought your house 10 years ago and you have never refinanced or done an appraisal since for a mortgage, then it's very possible that you would need an appraisal of your home. And like I said, an average appraisal right now is less than $500. It's usually around $400 to $450. So let me just go through some of these questions. So Diego's asking, if I made some renovations to my house without a permit, and you did this 5 years ago, you know what? So that is going to come down to the appraisal. So if an appraisal gets done on your home, you know, I've seen plenty of appraisals pass where there was no permit done, but that's more going to be on the shoulders of the appraiser. Okay, I'm not an appraiser, so I can't really speak to that fact of how they're going to appraise your house. But I've definitely seen properties that have been appraised that don't have permits. Typically, the appraiser will just write in there, you know, no permits were pulled. However, the work was done in what they call a workmanship or you know, workman-like manner. So it wasn't done shoddy. It wasn't done bad. It was done professionally. If the appraiser can attest that the work was done professionally, okay, even if there's no permit, then in many cases they may allow that to pass through the appraisal. Sophia's asking, if you pay closing costs up front, does it make a big difference? So I have had a few clients that have, you know, insisted that, you know what, Rob, I have $10,000 sitting in my bank. It's not earning me anything, and I don't want to raise my mortgage at all, so I want to pay that money out of pocket. So yes, if you choose to pay that money out of your own pocket and you want to write a check at closing and you have money sitting there, then yes, you can do that. You can write a check to pay for the closing costs. Does it make a significant impact on the monthly payments? The last client I did it on, it made $30. They saved $30 a month, but they had to write a check for $4,500, and it lowered their mortgage by $30. Now, for many people, they would look at that and say, I'm not giving up $4,500 if it's only going to save me $30 a month. This client absolutely was adamant about it. They had just refinanced with me 8 months earlier, and they had just paid all the closing costs in the mortgage. So they really were adamant about not adding more costs because they had just refinanced within that year period, and they didn't want to keep ratcheting up the costs. So they made the decision because they had money in their bank account that was not doing anything for them. And they said, yes, even though it's only $30 a month, I want to pay that closing costs out of pocket. And yes, it made an impact on their monthly payment. For them, it was not a significant impact because they only had a mortgage for like $130,000. Now, if you have a mortgage that's maybe $250,000 or $350,000, then it might save you $80 a month or $70 a month or something. That's the type of thing that, again, we'll look at on an individual basis to see if it's going to make sense. And if you want to do that, we could look and say, hey, if you pay the $6,000 in closing costs out of pocket, your mortgage payment would be $40, $50, $60 a month less, and you could determine whether that's a good enough return on investment for you or not. Like I said, almost all my clients do not, especially right now, want to pay that out of pocket. They want to keep that money in their bank account, and they want to have their equity absorb the closing costs that they have, as we said, as an investment into their future and into their total financial circumstance, instead of paying that big chunk right up front. So I know we've gone for an hour. Definitely longer than expected, but I'm happy to answer these questions. So does anyone else have any other questions here?
Bedtime. Everybody's ready to go to sleep. I have, but do it, Diego. Say it.
Go ahead, Diego. Let's
Go for
get
it.
it done.
Own it.
I think I'll contact you later. I think it's better. I'm a little bit slow to understand these things, so I don't want to.
Absolutely. Absolutely. That's what we're here for. So I would like Sophia to send out after the call to everyone the link for HomeBot. So if you're a homeowner, you can sign up for that completely free. All my contact info, if you want to reach out to me directly, I'm happy to run some numbers for you. No cost, no obligation at all to see if refinancing makes sense. And I'm the first one to tell you if it doesn't make sense or if we need to step back. Maybe we need to wait a little bit longer for your credit or maybe your home value or all these different factors. I've had clients I work with for many, many years before they're actually ready to pull the trigger. So don't feel like it's too early. Even if you're not ready right away, you want to start that dialogue with a mortgage professional. You want to have a trusted advisor that you can bounce these ideas off of so that when you're ready, when the market opportunity is there, like it, for many people it is right now, we can go ahead and take advantage of the opportunity right away. Because these opportunities do not last forever. Okay, I can tell you that doing this for so long. This is my third refinance cycle that I've been in, or third refinance boom. So typically these are, opportunities that last for a few months, not for many years. So while you want to be thorough, you want to look at your options, you want to be methodical and making sure you're making a good move, you also want to be decisive. And that's the biggest trait I see in my clients that are multimillionaires, that own a lot of real estate, that are very successful. When they see an opportunity where the numbers make sense, when they see an opportunity for a good return on investment, boom, they can take advantage of it right away and not hesitate.
Make it rain, baby. Make it rain.
Make the rain.
Thank you so much for your time, Robert and Sophia. Oh, Grace, isn't that what we give? This is contribution to our community. Robert, I do have, sorry guys, you don't have to say, but the question on the credit score. What is the threshold credit score to do these things with? Like the minimum credit score that you
so as early as like February, we could refinance down to a 580 credit score. However, with COVID-19 and the lenders and the investors and everyone kind of tightening up the guidelines, right now the minimum credit score that I'm seeing beneficial refinancing approvals is 620. Okay, 620. Now,
so they need to work on their credit first.
Right. So if you're somebody that, if your credit is not at 620 or it's right around there, I have, doing this so long, I've viewed thousands of credit reports. I can probably give you completely free of charge some good insight by looking at your credit on certain actions you can take to pay down specific debt or, take certain specific steps that'll allow you to improve your credit. If you're somebody that needs a lot of work on your credit, maybe you're in the low to mid 500s or even less than that. If it's something that's going to be substantial, then there's a credit repair agency that I work with, mycreditguy.com, Sam Parker. I work with him for, about 5 or 6 years now. I know him personally, and he does a great job. And, if you need credit repair, that's who I would refer you to, because there are a lot of credit repair agencies out there. But unfortunately, a lot of them do not do very well. They charge a lot. They don't have guarantees. And, they don't get the job done. So I've worked with many credit repair agencies in my career, but Sam Parker, my credit guy, is the one that I've had the most success with. And they're very diligent about staying on top of things and notifying your loan officer of the progress on your credit so that immediately when your credit hits the level that it needs to be at, we can capitalize on that, and they'll be able to help monitor that as well.
Is there any charge up front with them?
So they do not charge up front. They do a free consultation for everybody and to see if they can be of help or not. And then if they take you on as a client, and if you decide to move forward, then they don't charge until after 30 days. So when you hit 30 days with them, they do have a fee that you'll pay. It's usually only a few $100s, but that's not done until after the first 30 days, which is the normal protocol with credit repair is that they're not allowed to charge up front. But a lot of credit repair companies do charge up front because they go under the legal license and they say, oh, we're offering legal services, and that's how they get around it, and then they charge up front. But it's actually illegal for a credit repair company to charge up front. It's just most companies do. They kind of get around it with that loophole. But My Credit Guy is not a law firm. They're a true credit repair, credit restoration agency. So they are, you know, they don't charge until after 30 days.
Wow, this has been cool. Now now it's sinking more to me because I'm with you, Diego. I don't get it all the first time either. Maybe it was just me doing it for myself that I wanted to do this. So
Yeah, and that's the thing. You know, you guys don't do this every day. You don't even do this every week. Maybe you only deal with this a few times in your life. That's why it's so important to have that trusted advisor on the real estate side, that trusted advisor on the mortgage side, that can bring these opportunities to you, that can really help you, not just to say, yes, we want another deal, like go for it, but can give you real advice and be able to say, you know what, right now it doesn't make sense to refinance, or right now you need to work on your credit to get the best deal. That's why you need the advice and you need an advisor to bring you down that path, because otherwise it can become very frustrating. It can become very confusing, especially if you're just dealing with one of these big box lenders where you're just a number and you don't have that personalized advice and that personalized service. And that's really the differentiation, like we were talking about, you know, earlier in the call, of not only a direct lender versus a broker, but just a true financial advisor and mortgage advisor versus just a loan officer or just somebody who's going to spit out a rate quote and a closing cost quote without giving you that full holistic financial perspective, not only how it affects you in the short term, but also in the long term and improving your, you know, your mortgage, your finances, your retirement, your debt, all this stuff, your credit. It all needs to be looked at as a whole. And that's why it's so important to find somebody. I don't care if it's me or somebody else, just find an advisor that can really take you under their wing and analyze this for you on an ongoing basis. Like I said, at least once a year, every single year, to make sure you're in the best financial position, because you'll be surprised how much you might be able to save when you start looking at this on an ongoing basis. Just like a portfolio, you know, of stocks. You're not just going to buy stocks and leave it for years. You're going to be looking at it with a financial advisor on an ongoing basis. Start looking at your real estate and mortgage as part of your investment portfolio and take that different perspective to be looking at it as on an ongoing basis. Not
You're
just
speaking with chefs here. You're speaking with chefs. That's the last thing in their minds. They're focusing on the next creation they're going to make in the kitchen. Will and Diego are chefs. They're artistas. They're artistas.
Absolutely, and that's why you want to focus on what you're good at. Chefs, being parents, your day job, whatever it is. That's where you want to focus. That's why you hire advisors to sell your house. That's why you hire advisors to help you with your 401k. That's why you want to hire an advisor to help you with your mortgage and all these things. You concentrate on what you're good at, and you want to bring in advisors that are experts in these different areas. Okay, it's the same thing as painting your house. Yeah, you could get a paint can and a brush and paint your whole house, or you could hire a professional painter. You could do it either way, but which way is going to get a more, you know, a better outcome?
Well, Diego is a professional painter too. He's an artist,
Exactly.
So he has beautiful hands. It's been really, thank you so much for your time, Robert. This has been really great. And Dija, you get the crown, Dija. You're here for the pure service of your clients, just to come and learn and know what's the best thing for them out there. Thumbs up for you. This is Dija, guys. That's Will. Oh, you guys met. You guys met. All of you met. We were together at the fire. Remember the last party we went to?
The chef after party.
The chef after party. You saw, yes, that's so funny. I completely forgot about it.
It looked different.
Thank you so much, Rob.
Thank you very much.
Thank you,
Absolutely,
Diego.
it was.
And Sophia, you will send us the app, right?
Yeah, I
Yeah.
appreciate it. I'll have
No,
Sophia
we'll
send
stay.
you guys out all the information after the call. By tomorrow, I'll make sure I get her an email with all the links and everything for you guys to sign up
Yeah,
for
and
the
if you guys
HomePod app.
want, you can also send me the email too, so that he can send it also, you know, what I'm being called an interrupter here. Sorry, guys.
So Sophia, what I'll do is I'll be sending you, first thing in the morning, because it is late. I don't want to miss anything. I'll send you an email with all the links, for them to reach out to me if they want to apply for a, questionnaire to refinance. I'll put that link in there, my social media, HomeBot, and I'll have her send that out to everybody on this call here tonight. And then you guys can feel free to reach out to me if I can be of assistance to you or anyone that you know. Share this information with others because they aren't really talking about this in the news and the media. Yeah, they're saying rates are low, but how does that apply to somebody that owns a home or is looking to buy, sell, or finance real estate? So hopefully in tonight's call, I've given you some more tangible information on how you can capitalize on this right now and how it can be a benefit to you. So share it with others. We will put out a video, at some point with some snippets of this that I can have Sophia send out to everyone. And I just appreciate everyone's time here tonight, and I look forward to speaking with all of you soon. Have a good evening.
Hey, Will. Wait. Will, are you going to stay? No. Okay.
Yeah. I'm waiting for you, Sophia.